Equity markets are plunging on the news that the trade war may not see a resolution before the 2020 presidential election. So should investors be looking for safety now, and where? Joining me in studio today, Christopher Vecchio, senior currency strategist over at dailyfx.com. Christopher, welcome back to the show. Good to see you again.
Thanks for having me again.
So just when things started to seem that they were calming on the trade war front, we get this fresh news today. How are you digesting it? Break it down for us.
Well, it really seems to me that this is related to President Trump's 2020 re-election bid. As long as he's been able to keep a trade deal within reach, but not quite there yet, he's been able to keep equity markets afloat. Why? We have the Federal Reserve positioned in a manner where they're going to keep rates low for the foreseeable future. Inflation's low, growth is low, and with the threat of the trade war looming, there's really no reason for them to raise rates. So for President Trump, perhaps the worst thing that could happen is if a trade deal does come together, in the sense that the Fed would have less of a reason to keep rates low and therefore stocks could struggle heading into 2020.
But could this really roil the global economy, Christopher? Because it's extending far beyond China now. There's also talk of hefty trades fees on France being slapped here by President Trump. So how does this play out, and could there be a global meltdown?
Sure, I wouldn't go so far as saying global meltdown right now, but I do think that we're starting to see a lot of small drops fill the bucket here. With respect to the U.S.-China trade war in particular right now, China has said, and there have been indications from China, that they don't really see a need to get a deal done at present time, because they feel that they may have a better chance of negotiating with a Democratic president. When we talk about what's going on with Europe, this is just another issue that could cause the U.S. economy to slow down. One thing that really sticks out to me right now with this trade war, farm bankruptcies are up 24% year over year. We've spent close to $30 billion bailing out farmers. That's more than twice what was spent during the auto bailouts. And so in this economy right now, yes, the income is there. Yes, we're seeing that farmers are doing well, some aspects of the U.S. economy are doing well, but it's done so effectively on the government till. And once the trade war disappears, are these long-standing supply chains going to be destroyed? For soybean farmers in the U.S., now that China's buying from Brazil, for example, are they going to stop buying from Brazil? I don't necessarily think so. Brazil's cleared the land. They've been burning down the rainforest to make room for growing soybeans. So this is a long-standing problem that just because the trade war ends doesn't mean that the U.S. economy will snap back to where it was pre-trade war.
What are you seeing on the FX front? Obviously, this is your expertise. We saw the Swiss franc rose on the news, U.S. dollar index dropping a bit here. How is it affecting currencies?
Sure. So there is a bid for safe haven demand right now, and Swiss franc, U.S. dollar, Japanese yen. But with respect to where the dollar goes from here, this has been a past few weeks where Federal Reserve interest rate expectations have really collapsed. Going into the October Fed meeting, there was an expectation of at least one more rate cut before March 2020. We've seen that eliminated, and now the next rate cut is expected in July 2020. So how much better could it get for the dollar from here? If the Fed's still in easing mode, we could see those expectations pulled forward, and the dollar could suffer against a currency like the euro or even the British pound, which is seeing the wind at its back with latest polls out regarding the UK election.
What sectors could benefit the most from the play out or the stalling of the trade war now? Could gold catch a bid here?
Yeah, gold really has struggled the last few weeks insofar as U.S. Treasury yields have been rising, particularly since the start of November. And that to me is the key function here. If U.S. yields continue to rise, that's where gold will continue to struggle. But on news like this, where we are seeing Treasury yields go down, we're seeing a move to safe haven currencies, that's where gold and silver tend to benefit. At the end of the day, gold and silver don't have coupons, they don't have dividends, they don't have cash flows. And so in an environment defined by falling real yields, that's when gold tends to do the best, and that's where we are right now.
I need to get a question in on Bitcoin, because the last time you were on, you said, look, Bitcoin won't have an explosive rally again until the world is on fire. Do you still feel like that today?
I do, and the world hasn't lit on fire yet. We've had a lot of tinder laying around, but we actually haven't seen the spark. Equities are at all-time highs. Gold has come off. We've seen all the fears about the U.S.-China trade war provoking an immediate recession in the United States. Those calls have fallen flat. Right now, the Atlanta Fed GDP growth tracker for Q4 is sitting at a meager 0.4%. So it's not like we're looking at rip-roaring growth here, but still, we're not looking at a condition for a meltdown.
Well, on the topic of recession, you're right. The talks have fallen flat when, just 2 months ago, that's all we were talking about.
Right.
Is that justified?
Yes and no. So the basis for all those discussions was that the U.S. yield curve had inverted.
Right.
And although it's a very small sample size, you go back to 1945, the post-war era, 7 out of 7 times the yield curve inverted. It was a viable signal for a recession starting within the next 12 months. And so for a period there of almost 3 months, we had the yield curve, both the 2S, 10S, and the 3-month 10-year spreads inverted. They've now moved out of inversion territory. And so all of a sudden this historical allegory, it's kind of fallen apart for some traders. And then you look at consumption data, you look at government spending, U.S. deficit is up at its highest level since the financial crisis. There's little reason to think in the very near term right now a recession will materialize.
Christopher Vecchio, thank you so much for joining us for this rundown today. I appreciate it.
Glad to be back.